Morning, everyone. Thank you very much for joining me. This is the morning market review with myself, Russell Shum, Senior Market Specialist at FXCM. And my email address is rshore@fxcm.com. It's Tuesday, it's the 14th of Feb, 2023. I'm going to just go ahead and bring up a high-risk investment warning. And I'll keep this on screen for a few moments. What we'll do today is I just want to run through the stochastic with you in preparation for a possible momentum move today, because the CPI is coming out at 3:30 ZA, 1:30 PM UK. It's going to be market moving. It really depends if there's going to be an upside or a downside surprise. So if you're trading over that release, be aware there is going to be volatility. It's probably the most hotly anticipated calendar release for this week. I mean, there's a lot of data this week, but CPI is going to be right up there as number one. I'm going to go ahead and bring up our market commentaries disclaimer. I'll keep this on screen for a few moments as well. Hey Raj, morning to you. Nice to have you on the webinar. Can I just double check you guys can hear me, see me, and see screen, right? Just let me know. Okay, thanks. All right, thanks Shadrach. Awesome. All right. Hey Anna, nice to have you on the webinar as always. All right, our references. I'm actually going to just be using TradingView today. I beg your pardon, I'm just going to be using MarketScope today. I won't be looking at TradingView. We'll take a look at the. I want to take a look specifically at the stochastic. And hey Demira, nice to have you on the webinar. Thanks for joining. Okay, so let's just talk about what the stochastic is. And to me, you know, the more that I use the stochastic, the more I'm impressed by the indicator. It is a lagging indicator. There's no doubt about that. Okay, you can use the fast stochastic, which we do in some of our systems, but this one is a slow stochastic, so there is a slowing factor here. But what I want to suggest to you is that you look at this in terms of where it is relative to 80, where it is relative to 20. If you want to give it a little bit more leeway, maybe relative to 70, relative to 30, but you don't want to look at this as in terms of overbought, oversold. That's not what the indicator is designed for. Again, I've seen it written in textbooks about being oversold, oversold. That's incorrect mathematically. It cannot be. In fact, George Lane, the originator of the stochastic, used it predominantly for divergences. Okay, not overbought, oversold, which it cannot possibly have an overbought, oversold. We're going to go through the we'll go through the formula very quickly just to explain why it cannot, and then we'll take a look at how it can be used today to potentially help us. So I'm just bringing up Microsoft Paint, and I'll put down the formula very quickly. So the formula would be close minus low. Let's put these in brackets. Close minus low. Let me try that again. All right. It's going to be, I'll use caps, close minus low divided by high minus low. Okay. That's the formula. Okay, it's a very simple formula. You can add a slowing factor to that. We won't talk about the slowing factor now. And the best way to take a look to actually understand this, it's really a very important principle. It's momentum based. In my estimate, one of the best momentum indicators out there. So if we're taking a look at a high and a low, okay, take a look at a high and a low, and let's give the high and the low some figures. Let's call this 10. Let's call this 5. And right away, you can see that the denominator, high minus low, well, that's going to equal 5, right? That's going to equal 5. What happens if the close is at the high? We'll just put a little bit of a left tick there, just change the color so we can see it. So what happens if the high is also 10? So it's trading at its high, 10. Well, then it's going to be 5 over 5, right? 5 divided by 5. So 5 divided by 5, okay, we all know is going to equal 1 or 100%. Okay, if we had to make it into a percentage, right? So if you're trading at 100%, you are at the high of the range. So is that bullish or is that bearish? Well, it has to be bullish. The longer it stays at the high, okay, so if it goes 11, 12, 13, 14, the stronger the momentum. If it's trading, let's say at 8, and I'm going to test my mathematics. Let's say it's trading at 8. Let's call it 9. Be better to call it 9. All right. So we've got 10 minus 5. The denominator is 5. What's the numerator? The numerator is 9 minus 5. Well, that's 4. Right? 9 minus 5 is 4. Well, what's that? 4 over 5. Okay, 80%. So in other words, you're in what we call you're effectively within the top 20%, right? Think about it in terms of a class of 100 students. The top 20 are in that quintile, the top quintile, right? The longer you stay in the top quintile, the more you'll be recognized as one of the smartest guys in the class, right? So that's what we're talking about. So now the idea here is how long can the tick, let's make it a different color, stay in the upper quintile. The longer it stays in the upper quintile, the stronger the momentum. If it hits upper quintile, like one student has one phenomenal paper and then just comes back to sort of the middle, that's no good. We really need to be backing the strong stocks. You know, the guys that hang around in the top 20%, and that's what stochastic is. So you go through to the stochastic here, and it's 0 to 100, 0 to 100. If it's in 80, then it's in the top quintile. The longer it stays in the top quintile, the more momentum there is. Here, let's put in, excuse me. So it stayed in the top quintile from the 13th of the 2nd. This is an hourly chart, to the 14th of the 2nd, from 1 o'clock my time to 6 o'clock in the morning my time. Well, what a great swing. The longer it stays in that upper quintile, the better it is. What a great swing. Now you can use this on any time frame. Okay, we're looking at it over 15 candles. Okay, so you could look over, if this is over 15 hours, you can look over 15 minutes. If you're down onto the minute chart, it gets a little bit too close to the tick there. But the idea is, when that inflation data comes out, when that CPI comes out, well, you can start looking to see where the stochastic positions itself. Is it going to position itself? Okay, so we're looking at NASDAQ here. Is it going to position in 80, or is it going to drop down to 20? If it drops down to 20, then I can tell you that inflation has got an upside surprise. We're pushing down into 20. If it holds at lower quintile, there's a swing to the downside. If it's a downside surprise, it's going to move strongly into the upper quintile. The longer it holds, okay, the better it's going to be the swing. Take a look at this in terms of euro. Okay, euro is another one that we can watch. Okay, let's bring up euro. Hey, Howard, morning to you. All right, take a look at this. This is exactly what we're talking about. Okay, it's the upper quintile there. Okay, it's been swinging ever since. These two over here were very strong, so it sort of it's giving us a little bit more of a flat trade. It's still moving northeast, but it's a little bit flatter. But that's because we've got a very strong. But the idea is that the longer it maintains, okay, the longer it maintains this upper quintile, the stronger it's going to be in terms of a swing. Now, if you looking to sort of trade a shorter time frame, drop down to say the 5 minute. Okay, and we'll take a look. Here is no good. Here no good. Here is no good. It hits, drops out. See that's kind of the student that just got the one paper right and then falls back into sort of average. This is no good. Hits and drops out. That's no good. Okay, we're looking for sustained movements. Let's go through to NASDAQ. Okay, this is better. Okay, so it's not quite in the upper quintile. This is probably in the upper quartile, but we kind of get a fairly strong movement here. Nice swing. It would have been better for our example if it was in 80, but this is probably from about 70%. So in the top, sort of the 70, it's within the 70th percentile, right? You can think about it that way, within the 70th percentile. So the idea here is we're looking to try and catch these momentum moves, and you can really apply this on multiple time frames. So if we go through to Euro again. Okay, let's take a look at Euro on a daily chart. Okay. Kind of hits here. How many pips is that? Okay, that's about 30 pips. It's a little flat as well, but this one's better. This one's a better example. Okay. Here's a nice one. Okay. So the idea here is we're trying to get the momentum behind us. The stronger the momentum, the steeper the gradient. The steeper the gradient, the more pips for us, right? You can't use this with money management because, of course, you don't know which of the movements are going to stick and which are going to fall. So we needed to move into 80 and hold. It might hit 80 and fall. If it falls, you need the stop loss. You can use this if you're a positional trader. Okay, if you're a positional trader. Okay, hits here, it's still going. Okay, now we're talking significant. Okay, let's see what's that in pips. Okay, here we're talking 196 pips. Okay, because it's on the weekly scale. So you can see that the momentum, in terms of a momentum measure, you're going to search far and wide to find something which is you're going to search far and wide to find something which is sort of as sort of plain to see than it is with the stochastic. Alrighty. Any questions? So you can use this in conjunction with the CPI announcement. Just make sure that you are using your stop loss rules as well. Any questions? Please go ahead and type those in. Alrighty. Let's wrap up here, guys, and I shall chat with you tomorrow morning. Thanks very much. Cheers.